The Japanese yen recently surged by a record 10% within the space of 5 weeks. We've actually only seen this type of move on the Japanese yen twice in the last 30 years of data, once in March of 2008 and once in September of 1998. We can see that on this chart right here that shows the 5-week return of the Japanese yen that recently hit the highest level since 2008 and before that 1998. Now in all three of these cases, the US stock market was seeing aggressive moves down. In 1998, stocks rapidly dropped by 20%. In 2007, the S&P 500 dropped by an impressive 60%. And in 2024, the stock market has already dropped by around 10%. Now, you've very likely already seen all of the headlines and videos talking about the unwind of the carry trade on the Japanese yen. And we're going to talk about what that is exactly and what historical data tells us about this. But first, I want to show you what happened in 2007, right before the global financial crisis with the Japanese yen that might give you a different perspective on what's happening today. This is a chart of the Japanese yen between 2003 and 2012. Now look at what happens when I add the US unemployment rate on top of the Japanese yen. We see there was a very strong correlation between the currency and the state of the US economy at the time. Between 2005 and 2007, the Japanese yen was generally weakening as the unemployment rate was falling. When the unemployment rate began to rise, all of a sudden you saw a major breakout in the Japanese yen that continued to strengthen as the unemployment rate rose during that period of economic turmoil. This entire period, of course, saw a lot of weakness in US stocks. Now, fast forward to today, and we see there's been a very similar relationship. The Japanese yen was weakening substantially between 2020 and 2023, as the unemployment rate was generally moving lower. But with recent economic data pointing towards a rising unemployment rate, all of a sudden we've seen quite a large recovery in the Japanese yen. This is to show you that we've seen this type of setup on the Japanese yen before, and that as financial markets transition from a non-recession environment to a recessionary environment, you can see a big move up in the Japanese yen. So you can call this a carry trade unwind if you want. I call this a risk-off move in financial markets, pricing in a recession. Now, it's true that Japan has much lower interest rates and a much weaker currency than the US, which means that many investors borrow the Japanese yen at low interest rates in order to buy other assets that have a higher return, like, for example, US technology stocks. This is what a carry trade looks like. People basically go short on the yen, borrowing the currency and buying other assets with that currency in order to get leverage. Carry trades are a way to get leverage. This is what the Nasdaq 100 looks like priced in Japanese yen. It gave twice the return as the Nasdaq 100 priced in dollars between July of 2020 and July of 2024. Now, of course, like any form of leverage, it works well while things are going up. But as you can see in the month of July, the Nasdaq 100 priced in yen took quite a big hit. But the point is that the Japanese yen wasn't the cause behind this move down. It just exacerbated the size of the move down. The cause behind the move down were the recessionary data points that started to come in right here. Without recessionary fears, it's very likely that leverage would have continued to build up. So what happens next depends on whether or not the US economy continues to weaken like it did, for example, in 2008. If that is the case, it could cause the Japanese yen to continue strengthening and for this type of big deleveraging to continue. But if the recessionary fears begin to dissipate, we could actually see the very opposite happen, where leverage begins to build up in the system again. That's where this 1998 episode that we discussed at the beginning of the video is very interesting. The Japanese yen was weakening aggressively between 1995 and 1998. This was a period of time where US stocks were performing exceptionally well. And you had the same phenomenon of investors taking advantage of the weak currency in order to leverage themselves on US stocks. All of a sudden, we witnessed a spectacular reversal in the Japanese yen, which was combined with a large drawdown in the US stock market that dropped by around 20%. Now, we know that this drawdown in the US stock market was caused by two things: the Asian and Russian financial crisis and the collapse of LTCM. Now, these ended up being temporary growth scares that never actually led to a recession. Once financial markets realized that, the S&P 500 surged back to all-time highs and the Japanese yen began to weaken. So fast forward to today's similar setup. If the recessionary fears that triggered this move down in the stock market and triggered this move up in the yen begin to die down and not actually lead to an imminent recession, it could be that this chart starts to morph into what happened in the 1998 episode. Now, I know that some of you are going to point out that the Japanese central bank that hiked interest rates here was what caused the move up in the Japanese yen. Now, the fact that they did that the very same week as recessionary data came in the US means that we'll never know for sure exactly what triggered what. But the Japanese central bank has already come out to say that they'll stop raising interest rates aggressively and keep a loose monetary policy following this market panic. So all else being equal, without more recessionary data in the US, the Japanese yen should begin to weaken once more. Now, we happen to believe that we are heading into a global recession, something we've discussed many times on this channel. But as we also talked about in the last two videos, these types of things typically don't happen overnight, as some people are trying to point out right now. Our timeline for the start of the recession has been the fourth quarter of 2024. We're still in the third quarter right now. Now, we did see the S&P 500 break down below a key price channel that makes us neutral on the stock market in the short term, but the general trend of the market remains to the upside right now, and we also highlighted to our members evidence that suggests the market is trying to find its footing and potentially setting up for a bounce. Now, whether that bounce turns into a large rally or if it quickly gets sold into, we're not ready to make a bet on that today. We're closely watching key levels and indicators to see if the market does show signs of resuming its bull market at least for another few months, or whether we should be preparing to increase our short exposure on the market as we enter a recessionary bear market. If you want to follow these things with us every step of the way, make sure to get yourself a subscription to our service.